Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 6th, and markets are starting the year like they chugged espresso. Copper at a record, chips rallying, the dollar forecast sounding like a roller coaster, and gold doing its classic, "I'm just going to stand over here and glow."
I love January markets. Everyone comes back from vacation and immediately decides, let's reprice the entire world. My inbox is already asking if I should buy copper, chips, and gold, and also somehow, all of them at once.
Today, we'll keep it structured and useful. 5 stories. Copper breaks above $13,000 a ton. Memory chip stocks rally on shortage talk. A 2026 US dollar forecast built around Fed cuts and fiscal spending. InPost pops on an acquisition proposal. And a markets wrap where silver jumps 2.8% and gold climbs on rate hopes and uncertainty.
That's a lot for 6 minutes. So basically, metal, chips, money, mailboxes, and more metal. This show is sponsored by the periodic table.
Story 1. Copper surged to a fresh record, pushing through $13,000 per ton. The headline explanation is tight supply, and investors betting the market's tighter than it looks, with inventories described as locked in the U.S.
Locked in the U.S. sounds like copper is stuck at customs filling out forms. Like, sir, state your purpose in America. Conducting electricity.
Simple version of the finance, copper is the economy's wiring. When demand expectations rise, or when supply feels constrained, price moves fast because you can't substitute it easily in the short run. If inventories are sitting in one region, the rest of the world feels tighter, and futures prices can gap higher.
So, copper is like when everyone wants the same phone charger, and suddenly it's $49.99, and you're like, I swear this used to be free in a drawer.
Why it matters: higher copper can mean higher input costs for construction, power grids, appliances, and EV-related infrastructure. For everyday budgets, that can show up slowly as higher prices for durable goods and home projects. For investors, it's also a macro signal. Copper strength often aligns with risk-on growth expectations.
If copper is screaming, the economy might be trying to bench press a car, or it's just traders doing cardio on the buy button. Either way, my DIY weekend just got more expensive.
Memory chip giants Micron, SK Hynix, and Samsung are sparking a global semiconductor rally as shortages stoke price hike expectations. The market is treating memory as the next tight bottleneck.
Yes, the classic cycle. Chips are cheap, then everyone builds AI everything. Then, suddenly RAM is a luxury good. Next up, would you like fries with that? No thanks. I'm financing a GPU.
Finance behind it in plain terms. Memory is more commodity-like than some other chips, so prices swing with supply-demand. When demand spikes, data centers, phones, PCs, AI servers, and supply can't ramp instantly, chip makers gain pricing power. That's why shortage headlines can lift the whole sector.
So it's basically concert tickets. There are only so many seats, and the resale market is chaos. Except the concert is cloud computing, and everyone's wearing a lanyard.
Why it matters for normal people: chip pricing can filter into the cost of devices and into corporate spending. If memory prices rise, big tech capex can shift, and smaller businesses may pay more for cloud services over time. For investors, it's a reminder that AI boom isn't just software. There's a real hardware bill.
The hardware bill is always the plot twist. Everyone's like, AI will write my emails. And then your CFO is like, AI also wrote us a $40 million invoice.
A 2026 US dollar forecast calling for a volatile, V-shaped year. Potential dip in the first half as the Fed cuts rates, then a rebound in the second half tied to government spending, new tariffs, and an AI investment boom. The key word is volatility.
A V-shape for the dollar is such a finance way of saying we have no peace, only vibes. So if I'm traveling, do I book the vacation in the dip or the rebound?
Simple version: interest rates are like the dollar's yield paycheck. If U.S. rates fall relative to others, holding dollars can look less attractive and the dollar can soften. But if fiscal spending ramps and tariffs change trade flows, and if global risk sentiment shifts, The dollar can rebound as capital moves to where it expects returns or safety.
So the dollar is basically a popularity contest between higher rates, government spending, and everyone panicking at once. Cool, cool, cool. Very stable, very adult.
Story 4. InPost, the Polish parcel locker operator, received an indicative acquisition proposal from an unidentified company, and the stock jumped about 20%. That's the market pricing in a potential deal premium, while remembering that indicative is not done.
An unidentified buyer is the finance equivalent of my friend goes to another school. But sure, the stock pops because everybody loves a rom-com. Will they? Won't they? Due diligence edition.
Why it matters. M&A waves often cluster when capital gets cheaper or when companies want scale. For everyday people, consolidation can change pricing and service quality. Think delivery fees, locker availability, and last-mile competition. For investors, it's a reminder. Single stock pops can be event-driven and not a free lunch.
Also, if you chase a 20% pop, you might end up holding a stock that's basically just a rumor wearing a trench coat. Be careful out there.
In the broader markets wrap, silver jumped 2.8% and gold moved higher, with gold described as eyeing $4,500 an ounce in the commentary. The drivers cited were rate hopes and political uncertainty, alongside a slightly softer U.S. dollar and traders waiting on Fed speakers and key reports.
Gold eyeing a number always makes me laugh. Like gold is standing outside $4,500 with binoculars whispering, soon. Silver, meanwhile, just sprinted 2.8% like it heard there were snacks.
The finance logic. When markets expect rate cuts, real yields can fall, and non-yielding assets like gold can look more attractive. Add uncertainty, geopolitics, policy surprises, and you get safe haven demand. Silver often behaves like a hybrid, part precious metal, part industrial input, so it can be extra jumpy.
So gold is the calm friend who says, let's be responsible. And silver is the friend who says, I bought a motorcycle. Same group chat, different risk tolerance.
Quick recap. Copper at a record above $13,000 per ton. Memory chips rallying on shortage pricing power. A V-shaped and volatile 2026 dollar narrative tied to Fed cuts and fiscal forces. InPost jumping on an indicative takeover proposal. And precious metals popping on rate hopes and uncertainty.
Actionable takeaway for the normal human portfolio? If everything is moving at once, maybe your job is not to predict every wiggle. It's to check your exposure. Like, do you accidentally own the entire periodic table plus a rumor?
Exactly. If your plan depends on one perfect forecast, volatility will humble you. Consider basics. Diversify across drivers, size positions so you can sleep, and if you're using commodities or single stock event trades, treat them as higher risk allocations, not the whole meal.
And if you're tempted to chase the hottest thing today, copper, chips, gold, just remember, the market can stay caffeinated longer than your budget can stay patient.
If you found this useful, subscribe and share BD Daily Finance News Podcast. Drop a comment with the one asset you're watching most in 2026. Copper, semis, the dollar, or gold. And what would change your mind?
And for the record, I'm watching my grocery bill. It's the most aggressive chart in my life. See you next time.